Hey everyone, Impact Financial, Vinny Samra here. This is another video about money and finance. And today we're going to talk about IULs, Index Universal Life, and how they can be utilized in so many different ways that we're pretty much calling it a financial Swiss Army knife. So once you begin to understand how to utilize it, transfer your money tax-free, accumulate your money tax-free, and use it as an estate planning tool, a capital expense account. One of the ways is diversification. So you've got 401ks and IRAs, your traditional vehicles for investing and saving for retirement. 401ks and IRAs, they're designed so that you don't pay taxes when you're accumulating the gains, but when you hit 70 and a half years old, which baby boomers are approaching that age now, you have to take out distributions. They're called RMDs, required minimum distributions. It's a requirement by the government, by the IRS, and you have to start taking your money out. Well, when you start taking your money out at that time, you have to pay taxes on it. A fixed tax rate either. Tax rates do change from time to time, and we've been in a lower tax rate environment for some time now. Way 50, 60 years ago, we had much higher tax rates, and we expect as a country, because we're spending so much money, our tax rates are probably going to increase. So if you're not close to retirement, you're 20 years out, 30 years out, you're more than likely going to be paying more on your taxes when you start pulling that 401k money out much in your life when you hit 70, 70 and a half. So Index Universal Life, there's no taxes at any time. The money accumulating, the gains are accumulating without paying taxes. You're taking the money out with tax-free income loans. That's also non-taxable because loans are not taxable based on the Section 7702 tax code. Tax-free death benefit with this type of product, you're getting a death benefit. Now, it does change over time, okay? If you're optimizing properly, if you're structuring your plan properly, we see that the death benefit actually in the later years is decreasing because your cash value is compensating for that death benefit. So you don't need such a large death benefit, which is great because now the cost of insurance is going down in the later years of your plan. And that's what allows you to accumulate more in cash value, put more of your money towards cash value, and it optimizes the fees. Your fees go down as well over time. And this is where it's very competitive versus any mutual fund or any other type of investment where the fees are 1% or more. With an Index Universal Life, the fees go down over time. They're so low, at some point, it looks like a no-brainer. You wouldn't want to go anywhere else if you were setting up a retirement plan. That death benefit, it's about $50,000 on average, and there has to be a minimum amount. It depends on your age. So work with a professional, a personal advisor that's going to give you the lowest death benefit so that you can accumulate more on the cash value side, because that's really what we're after. We're creating generational wealth, and this is the way to structure it. Equivalents that you have in bonds or in CDs, all of these cash equivalents, maybe with a credit union, you've got some money there, they're giving you 4%, 5%, I think nowadays. And that amount of money there, you're paying taxes on it. Any gains you have there, you're paying taxes on it. So instead of doing that, you can put your money in Index Universal Life, and it's basically a cash equivalent. If you structure it properly, you can take that money back out with tax-free income loan. Basically, you're paying yourself. You're taking your money back out, and you're not paying any taxes on the gains, and you're using it as a cash bucket. And you're not going to be paying any taxes on the gains. You're not going to be paying taxes on the loans. So it's much more beneficial than a CD or a bond or anything like that, because your upside is much higher than the 4 or 5% because you're linked to an index, which is typically an S&P 500 index, which is going to get you a lot more than 4 or 5%. I think this year, 2023, right now, we're closer to 20% in how much we've increased in the value of the S&P 500 index, which is a lot more than a 4 or 5%. Safety of your money. Okay, this is one of the most important things. Preservation of capital is the number one reason that anybody invests any money at all. Yes, you beat inflation, you want to beat taxes, but preservation of capital is number one, numero uno. And how do index universal life plans help you preserve your capital and give you safety? Well, it's safer than banks for sure. If you look at Nationwide, which is a company we recommend, the best rating is A plus. Okay, you're in the A's. Most banks are rated in the B. So that's the ability of the institution to pay off its debts. If an institution, a company, or a country, a B rating, anywhere in the Bs, well, it's less likely to be able to pay off its debts because the debt's probably too high relative to its assets and its income. And so this is very important because in 2023 here, we've had 3 banks now, large, Silicon Valley Bank, Republic Bank, and Signature Banks. 3 banks we've had this year fail and go bankrupt. They made bad bets. They bet on the bonds. Value tanked because interest rates skyrocketed, and they bought the bonds 2-3 years, and they went belly up. They were not able to continue doing business. I believe one of the banks got bought out by J.P. Morgan Chase, and the other banks consolidated with the other banks' assets consolidated. The banks are no longer in existence. They can no longer operate. But anyway, the point I'm trying to make here is we here at Impact Financial, any advice that we provide, want you to feel safe where you're putting your money, and your hard-earned not, if you put it in a bank, there is not as much safety as with an insurance company. In fact, when they give you 4% on your CD, well, guess what they're doing with their money? They're taking it, they're putting it with these insurance companies that have trillions of dollars in invested capital, and they are much safer because they have reserve requirements. Yes, there are laws created by the government, federal government, that have reserve requirements for insurance companies, which are much more stringent than some of these smaller regional banks or banks in general. Insurance companies have to maintain very strict capital requirements. Part is a capital expense account. How can you use Index Universal Life Plan as a capital expense account? So we touched on this in another video, and I'm going to put a link on that video up here so you guys can check it out. Basically, if you have a business, you're a real estate investor, or you're any type of individual where you need to get access to cash readily, easily. You don't want to go to the bank and try to fill out a loan application. Why do that? You can have an Index Universal Life Plan as basically your own bank. You become your own bank, and you don't have to loan yourself money at 10, 12% interest rate. You can loan it to yourself at 5% with a Nationwide. So having a capital expense account, hugely useful for a number of reasons. But let's say you're a real estate investor, you're looking to buy an apartment building, you need $1 million to put a down payment on that large apartment building. Well, instead of going to the bank, filling out an application, waiting for that to get approved, by that time your deal is probably already out of your hands. So if you have an Index Universal Life Plan, you don't really have to fill out an application. It's very easy because it's your money already, and the insurance company will give it to you almost instantaneously at a very low 5% interest rate. And the money that you pulled out, well, still, it's basically a phantom loan. It's still sitting in your Index Universal Life Plan, and it's still accumulating value based on the index you chose. And you're looking at about 7, 8, 9% return, and you borrowed at 5%. Well, you're taking advantage of arbitrage. So you're making money on the money you borrowed from yourself. This is how you become your own bank. This is what the wealthy and corporations do this. Walmart, Coca-Cola, they've been utilizing this strategy for years. So jump on this plan. This is the way to go. Estate planning. Okay, so if you set up an irrevocable trust, you can use Index Universal Life Plan to make sure that you don't have any estate taxes, inheritance taxes, and the death benefit, which is tax-free already, is going to be paid. It's going to be transferred to your use without any taxes being to the government. So this is another way that an IUL were to be a financial Swiss Army knife, right? Next part, pension maximization. Now, check it out. If you're a teacher, for example, and you have the opportunity to set up your pension where you can have a survivor's benefit for your spouse. Let's say your spouse passes away before you prematurely. That survivor benefit cannot be transferred to another spouse or to somebody else or a different beneficiary. So instead of you choosing the survivor's benefit, decline that if you're a teacher and set up an Index Universal Life Plan and put that money there, because now you could pick whoever to be your beneficiary. It doesn't have to be your spouse. Or if your spouse dies prematurely, you can set up a contingent beneficiary, a backup, so that money is not wasted. And that money can go towards whoever could use it. This is a much better way to utilize your benefits. Army Knife. And I hope you guys enjoyed this video. If you did, please comment, like. We'd love to get your feedback. And please subscribe to our channel. We appreciate all of your support. And that's what keeps us going. And we want to keep bringing you guys more content on these topics, friends. So please subscribe. Please support us. And until next time.